Indian options trading, much like options trading in other countries, involves buying and selling options on financial instruments, primarily in the stock, index, and currency markets. However, due to local regulatory frameworks and market conditions, there are unique features in the Indian options trading landscape that traders should understand. Here's a detailed breakdown. 1. What are options in the Indian context? In India, options are contracts that derive their value from underlying assets, which are typically stocks, indices, or currency pairs. Similar to global markets, Indian options come in two types. Call options. These give the buyer the right to buy the underlying asset at the strike price before the expiration date. Put options. These give the buyer the right to sell the underlying asset at the strike price before the expiration date. 2. Where are options traded in India? Options trading in India occurs on the major exchanges. NSE, India's largest stock exchange, where most options trades take place. BSE, another exchange that offers options trading, although it has lower volumes compared to the NSE. In the NSE, most of the options trading activity is concentrated in the Nifty 50 and Bank Nifty indices, which are the most liquid and widely traded index options. 3. Types of options in India. Stock options. These are options based on individual stocks, such as Reliance, TCS, Infosys, etc. Index options. These are based on stock indices like Nifty 50 and Bank Nifty. Index options are extremely popular in India due to their high liquidity. Currency options. The NSE also offers options on currency pairs like USD-INR, EUR-INR, GBP-INR, and JPY-INR. These are useful for hedging against currency risk. 4. Key characteristics of Indian options. European style. In India, stock and index options are European style, meaning they can only be exercised on the expiration date, unlike American style options, which can be exercised any time before expiration. Lot sizes. Options in India have a specified minimum lot size. Traders cannot buy or sell options in smaller quantities than the lot size. Expiration cycles. Options in India have monthly and weekly expiration cycles, especially for Nifty and Bank Nifty. Monthly expiries are typically on the last Thursday of each month, while weekly expiries for index options occur every Thursday. Cash settled. All options in India are cash settled upon expiration, meaning no actual delivery of shares or assets takes place, only the profit or loss is settled. 5. Important terms in Indian options trading. Strike price, the price at which the underlying asset can be bought or sold. Premium, the price paid for buying the option, which depends on factors like time to expiration, volatility, and intrinsic value. Open interest, the total number of open contracts for an option, an important metric for determining market sentiment. In the money, a call option is ITM when the underlying stock index is above the strike price, a put option is ITM when it's below. Out of the money, a call option is OTM when the underlying is below the strike price, a put option is OTM when it's above. 6. Why trade options in India? Options in India are used for speculation. Traders can speculate on the future price of stocks, indices, or currency. Hedging. Investors hedge their portfolios to protect against downside risk using options, especially put options. Income generation. Selling options, particularly covered calls or puts, allows traders to generate income through premiums. 7. Popular options strategies in India. Indian traders use a range of strategies based on market views and risk tolerance. Covered call, selling a call option on a stock that the trader already owns to generate premium income. Protective put, buying a put option on a stock that the trader owns to protect against downside risk. Bull call spread, buying a lower strike call and selling a higher strike call to limit profit and loss within a defined range. Bear put spread, buying a higher strike put and selling a lower strike put to profit from a downtrend with limited risk. Iron condor, selling an OTM call and put, and buying a further OTM call and put to profit from low volatility. Straddle and strangle, buying both calls and puts to profit from significant moves in any direction, often used around key events or earnings releases. 8. Options pricing and the Black-Scholes model. In India, options pricing is influenced by the Black-Scholes model, which factors in the current price of the underlying asset, the strike price of the option, time remaining until expiration, interest rates, implied volatility. Implied volatility is particularly important in the Indian market, as it can fluctuate significantly during events like elections, corporate earnings, or geopolitical events, impacting the premium. 9. The Greeks in Indian options trading. The Greeks help in managing options risk and understanding how options pricing will respond to changes in different market factors. Delta measures sensitivity to price changes in the underlying. Gamma shows the rate of change in delta. Theta indicates time decay. Vega shows sensitivity to volatility. Rho indicates sensitivity to interest rates. 10. Options trading regulations in India. The Securities and Exchange Board of India regulates options trading in the country. Key rules include Margin requirements. SEBI requires traders to maintain a margin when writing options, as these positions expose them to potentially unlimited losses. Margins vary based on volatility, liquidity, and other factors. Restrictions on naked options. Retail traders often face restrictions on selling naked options due to the high risk involved. Weekly and monthly expirations, introduced to provide traders with more flexibility in managing positions and liquidity. Position limits. SEBI has position limits on options contracts to prevent any single trader from dominating the market. 11. Key indices for Indian options traders. Nifty 50, the benchmark index for the Indian stock market, with high liquidity and widely traded options. Bank Nifty tracks the performance of the banking sector, highly volatile, popular for weekly expirations. 12. Example of options trading in India. Buying a Nifty call option. If Nifty is at 20,000 and a trader believes it will rise to 20,500, they may buy a call option with a strike price of 20,500, expiring in 1 month, at a premium of 150 rupees. If Nifty rises above 20,500 before expiration, the call option will gain intrinsic value, potentially allowing the trader to sell it at a profit. Selling a put option on Reliance. If a trader believes Reliance won't fall below 2,500 rupees, they might sell a put option with a strike price of 2,500 rupees at a premium of 50 rupees. If Reliance remains above 2,500 rupees until expiration, the trader keeps the 50 rupees premium without any obligation. 13. Risks in Indian options trading. Options in India carry various risks. Market risk. Fluctuations in the underlying asset can result in significant losses. Liquidity risk. Although Nifty and Bank Nifty options are highly liquid, individual stock options may lack liquidity. Time decay. Options lose value as they approach expiration, particularly for OTM options. Volatility risk. Changes in market volatility affect the premium, especially for OTM options with high vega sensitivity. Conclusion. Options trading in India provides a range of opportunities for speculation, hedging, and income generation. Due to the regulatory framework, focus on cash settlement, and popularity of index options, the Indian options market has unique characteristics that traders must understand. Managing risks through knowledge of the Greeks, position sizing, and adherence to SEBI regulations is crucial for success in the Indian options market.